Welcome back to the Deep Dive, the place where we take a stack of sources, articles, reports, and expert notes and extract the essential insights you need to be truly well-informed. Today, we are deep diving into property risk.
That's right. And, if you're preparing for a mortgage, you probably spend all your time worrying about your income, your credit score.
Right, and whether you can even afford the monthly payments.
Exactly. But today, we're going to flip the script and look at the property itself.
Exactly, because a mortgage application isn't just an assessment of you, the borrower. It's a deep, almost clinical risk analysis of the property you're offering up. The lender is asking one main question.
And that question is, if the worst happens, if the borrower defaults, can we sell this house immediately?
And for enough money to cover the debt.
That's the core mission. The property is the ultimate security for that loan. Our sources make it so clear that a lender's single biggest priority is marketability.
They have to be confident.
Absolutely confident that the sale proceeds will be enough to settle the entire debt and quickly. If anything, physical, legal, whatever gets in the way of that, they're not going to lend.
So what's the basic information they need? I mean, it sounds obvious, but when they do a valuation, they gather the essentials?
Right, the address, the purchase price, the property type, house, bungalow, semi-detached.
The method of construction, and this is the crucial one, the tenure freehold or leasehold. And if it's leasehold, the exact number of years left on that lease.
And this leads us straight to the first major hurdle for any lender. They must have vacant possession.
That sounds very legalistic. What does it actually mean?
It's a non-negotiable requirement for most residential mortgages. It's a guarantee that the property is empty when it's transferred.
And what's the risk if it's not, if someone's living there?
Well, the problem isn't usually a standard assured short-hold tenancy in AST. That's common in buy-to-let.
Okay.
The real danger is a sitting tenant, someone with a protected tenancy agreement that falls outside those modern AST rules.
And because that tenant is protected by law.
Their presence just radically reduces the market value. It completely hampers the lender's ability to repossess and sell with vacant possession.
So it doesn't just lower the price a bit, it shrinks the pool of potential buyers to almost zero, except for specialists.
Precisely. If they can't sell it quickly, their collateral is compromised. It's a massive threat.
Okay, let's unpack this and start with the legal foundations. So before we even think about value, we have to establish who actually owns it, the title.
Yes, the classes of title. They're all about giving the lender confidence that the person selling the house actually has the right to.
Because if the title is weak or in dispute,
the property is either worth less or it's just deemed unsaleable by the lender's legal team. It's a spectrum of certainty.
Okay, so lay out that spectrum for us, starting at the top.
The gold standard is absolute title. This is the clearest, most secure form of ownership. Everything is fully established.
And after that?
Then you have good leasehold. This is very common for leases over 7 years. So the title of the leaseholder is established, but there's a nagging doubt.
A doubt about what?
The lender isn't guaranteeing the right of the freeholder to have granted that lease in the first place.
Wait, let me just clarify that. So absolute title is like buying a car with the perfect title. But good leasehold means you have the title, but you're not 100% sure the person who sold it to you had the right to.
That's a great way to put it. The risk is subtle, but it's real. If the freeholder's title turns out to be defective later on, your lease and the bank's security could be challenged.
And then it gets even murkier. What about possessory title?
Well, possessory title means the owner is registered, but they aren't protected from a claim by a previous owner from before that registration. That's a huge red flag for a lender. It just raises the risk of future, very costly litigation.
Which sounds a lot like adverse possession or squatter's rights.
It's directly connected. That applies if land has been occupied without a challenge for a set period. For unregistered land, it's 12 years. For registered land, it's 10.
And the risk for the lender is inheriting that legal fight.
Exactly. It prevents a quick, clean sale.
Okay, this is where it gets really interesting for me. Even with a good title, you can have external problems that threaten the value. What kind of legal disputes is a conveyancer looking for?
So the conveyancer performs due diligence. They formally ask the vendor about any disputes, and the vendor is legally obligated to disclose them.
And if they don't?
They're liable for legal action later, which again threatens the value for the new owner and therefore for the lender.
So what are the common disputes that make a property toxic?
Things like boundary disputes, ongoing issues with trees or hedges, problems with access rights, like a shared driveway, or documented noise issues. Buyers don't want to buy a lawsuit.
Okay, let's move on to tenure troubles. Freehold versus leasehold. Freehold seems simple, but even that has issues a lender will flag.
Freehold is generally better, yes, but its value can be hit by easements or covenants.
An easement is a right for someone else to use your property, right?
Yes, a classic example is a neighbor having a documented right-of-way through your garden.
That's a huge restriction. I mean, if you have two identical houses and one has a path running through the yard, it's obviously going to be worth less.
Absolutely. It compromises privacy and enjoyment. A covenant, on the other hand, is an obligation on the owner. It might restrict what you can do, like forbidding certain renovations.
And we have to talk about the notorious flying freehold.
Ah, yes.
Uh,
This is when part of your freehold property is built over or under land owned by someone else. Maybe your bedroom is over your neighbor's entryway.
and the problem is liability. Who fixes the leak?
Precisely. Lenders are terrified of unclear liability, so it can have a really adverse impact on the value.
What about freehold flats? That sounds like the worst of both worlds.
They are notoriously difficult to mortgage. The fundamental problem is there's often no clear legal mechanism, no management company responsible for the commonly owned parts.
Like the roof or the main structure.
Exactly. So any major repair can only be solved through expensive, lengthy litigation, a major red flag for any bank.
Okay, now for the classic time bomb. Leasehold. What is the single biggest threat to value here for a lender?
It's the length of the remaining lease term. A lease is a wasting asset. It's diminishing because the property eventually goes back to the freeholder.
So if the lease expires during the mortgage term,
The lender is left holding an asset that is essentially worthless, zero value.
which means they have specific minimums.
They do. Lenders typically require a minimum unexpired period, often somewhere between 30 to 80 years beyond the entire mortgage term. If the lease is too short, the property's value is hammered.
And we cited data from the RACS showing that 80 years is the critical threshold. Why that specific number?
Because that's where the concept of marriage value traditionally kicks in. When a lease drops below 80 years, the cost to extend it jumps because the freeholder can demand a premium.
And that extra cost hits the property's value.
It hits it hard, which is why lenders start to panic when that 80-year threshold gets close.
But the law is shifting on this, isn't it?
It is. The Leasehold and Freehold Reform Act of 2024 is set to change this landscape. It aims to abolish marriage value entirely, which removes that huge financial penalty.
And it also makes it easier to extend the lease right away.
Yes, it removes the old 2-year ownership requirement. It's all designed to stabilize the security for the lender and the value for the borrower.
So beyond the paperwork, how do the actual physical features of a property, the type, the construction, affect how much a bank will lend? Let's start with property type.
Well, there's a general hierarchy of security. Detached or semi-detached houses are seen as stronger security than terraced houses, and houses are generally better than flats.
What about bungalows? They can be expensive and seem really popular.
And that's actually the problem for the lender. Their popularity is with a very specific limited market, usually older or mobility-restricted buyers.
So it's a niche demographic.
It is. And that poses a specific risk called limited marketability.
Okay, let's get granular on that. Why does a lender care if the market is limited?
They're worried about a forced sale situation. If they have to repossess, they need to sell quickly. If the buyer pool is small, they might be forced to accept a deep discount.
The smaller the market, the bigger the potential loss for them.
You've got it. So how does age and condition factor in?
A period property can attract a premium, especially if it's unique. But if the area is full of similar older homes, that premium can disappear. Condition is everything.
So a fixer-upper is an opportunity for me, but a risk for the lender.
Exactly. They are only looking at the value now, not the potential value after you've done the work. They need sufficient security today.
Shifting to construction, why do the materials matter so much?
Because construction determines the expected life of the dwelling. Traditional construction brick, mortar, slate roof is the standard because it lasts a very long time.
Much longer than a mortgage term.
Right. But non-traditional or non-standard construction, that can be difficult to mortgage because the lender worries about faults that could reduce its lifespan.
And the classic example of that risk would be?
Prefabricated housing, the kind built heavily after World War II. These often had an expected lifespan of only 10 years.
even though many lasted much longer.
They did, but the core concern for the lender is, will this structure fail before the mortgage is paid off? If it fails, the collateral just vanishes.
So today, if you want to mortgage one of these non-traditional homes,
It has to be backed by an accreditation scheme like the NHBC scheme. This gives the lender confidence that the property will last the duration of the loan. Without that, it's often impossible to get a mortgage from a high street lender. Okay, moving on. Some risks are completely external and can wipe out value overnight. Let's look at the legacy of the Grenfell Tower fire.
yes, this created a huge crisis in financing for multi-unit buildings. After the disaster, lenders immediately started declining mortgages on tall residential buildings, unless the owner provided an EWS-1 form.
And that form is a fire risk assessment of the external wall. But how does that affect the lender's finances?
The lender sees the EWS-1 form as confirmation they aren't lending on a defective building that carries this huge, undefined liability. If the cladding is faulty, the remediation costs could run into millions.
And that just destroys the value of their security.
Completely. And while it initially focused on buildings over 18 meters, the guidance now confirms the EWS-1 form is required for any residential building where the external wall system raises fire safety concerns, regardless of height.
It's about a systemic risk of catastrophic failure.
It is.
Next up, environmental risk, flood insurance, and subsidence. A history of either can make a property totally toxic.
It can, because it impacts insurability, which directly impacts value. If a property is uninsurable, a lender won't touch it.
And that's where the flood re scheme comes in.
Yes, to combat this issue. Flood Re, which runs until 2039, is a reinsurance scheme subsidized by a levy on all home insurers.
And how does that make a difference on the ground?
It provides affordable insurance for residential properties built before 2009 in high-risk areas. The premium is capped, and it's not affected by the property's specific level of flood risk. It basically turns an uninsurable property into a lendable one.
That's a massive government intervention to stabilize the housing market.
It is. It ensures security remains viable where it otherwise wouldn't be.
And what about flats above shops? It seems convenient, but is it a risk for lenders?
Multi-use properties are generally viewed with caution. The problems are noise, smells, things like that from the commercial part. But the key factor is the risk of change of use.
So it might be a quiet office now, but it could become a takeaway tomorrow.
Exactly. And that could ruin the quiet enjoyment, and therefore the value of the flat above overnight. A flat above a small parade in a quiet area is always easier to mortgage than one on a busy high street.
Okay, for our last section, let's talk about investors. For anyone doing a buy-to-let or BTL, the assessment is unique. It's not just about the house, it's about the income.
That's right. Lenders need confidence in two things: that the property is adequate security, and that the rental income is enough to maintain repayments. And that second part is what the PRA stress tests are all about.
Let's spend a moment on those stress tests because they really dictate what an investor can borrow.
The Prudential Regulation Authority, the PRA, requires lenders to assume a worst-case scenario. They have to assume high interest rates, much higher than the current rate, and test if the rent can still cover the payments with a buffer.
And what are the typical coverage ratios lenders use?
They often require the rental income to cover between 125% and 145% of the assumed stressed interest payments.
So if the assumed payment is £1,000, the rent needs to be at least, say, $1,450.
Exactly. That buffer is there to absorb costs like void periods, maintenance, and fees. If the property doesn't meet that rental coverage ratio under the stress test, the loan won't be approved.
Investors are always focused on yield. How do those metrics connect back to the bank's perspective?
Well, the basic one is gross yield annual rent as a percentage of purchase price. But the more accurate one is net yield, which is the rent minus all the running costs.
And the lender wants to see that net income is robust.
Robust under pressure, yes. And ultimately, the investor's looking at the total return, which includes capital growth. They need that total return to significantly outweigh less risky assets, like just putting cash in a savings account.
Hence the search for property hotspots.
To wrap this all up, a lender is fundamentally wary of anything that compromises immediate saleability or long-term security. The biggest red flags are undefined liabilities like easements or flying freeholds.
Anything suggesting a diminishing asset life, like a short lease under 80 years?
Non-standard materials that shorten the property's lifespan, and these systemic risks like cladding or a history of flooding that makes insurance a problem.
It's a complex picture. But understanding these lender-side factors is the shortcut to being truly well-informed about property risk. Thank you for taking this deep dive with us.
But consider this. The law around property ownership is evolving, with the recent Leasehold and Freehold Reform Act trying to simplify tenure. But given that one of the biggest risks to a lender is difficulty establishing liability for communal parts of a structure, a problem we see with things like freehold flats and external cladding, how might the trend toward highly integrated, multi-unit buildings continue to frustrate these attempts to simplify ownership and challenge the very concept of secure, easily defined property ownership in the future? Something for you to mull over until next time.